The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
All right, welcome to Crazy Wealthy, Fix It Friday. I'm going to start today by sharing with you a parody of an advice construct that was emailed to me by a client. And then we'll go into the podcast because I think it's very appropriate. So it starts off, it says, as the report goes, a local financial advisor, Rick Rosas, announced that now was the time for utter panic and urged his clients to hastily make huge money moves based on pure emotion. Rosas called each of his clients one by one, advising them to let fear drive their financial decisions and recommending immediate changes before taking time to think it through. He says, "What are you doing sitting there? Buy, sell, panic," said Rosas, speaking to a young couple worried about their financial retirement account. Take that fear in your gut. Let it overwhelm you until you make massive, life-altering financial decisions. Do it quick. Hurry, he says. According to Rosas, the stock market has never fallen 10% before, and it's probably a sign of the apocalypse. He says, this is unprecedented. When faced with such uncertainty, the best course of action, he tells them, is to freak out and do something drastic. I'm encouraging all of my clients to abandon any semblance of a long-term strategy and to pull the trigger on whatever their emotions are telling them to do. At publishing time, Rosas had advised several clients to move all the money from their retirement accounts into something safe, like Bitcoin. So I start with that today because we're now approaching what's called a bear market, down 20% from recent highs. And what I just read to you is actually how people are going to feel they should be reacting after they watch the catastrophism on the financial media, listen to their friends, and respond to their own human emotion, bias-based signals. So I thought that was a good segue into today's podcast.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hi, everybody. Thank you for tuning in to another episode of Fix It Friday. I'm happy to be broadcasting today at a time when we're just about at a new bear market, which is to say down about 20% in the S&P 500 from its recent February highs. And I only say I'm happy to be broadcasting during that time because it's during those times when investors most need counseling to make sure that they maintain the proper temperament, helping them to avoid making the big mistakes that many make during these environments. So today, I'm actually going to talk about a couple of things that are related. One is what I call the three most important numbers in investing and wealth management. And the question that I often get during periods like this, which is, what new portfolio decisions are you recommending that your clients make in order to be able to survive the environment that we're going through with their money? And so I'm going to start off with the question, what are some of the new portfolio moves that I'm advising clients to make? And the answer to that is my clients don't have any new portfolio moves to make. They made their decisions, their portfolio decisions, all of them, when they decided that they needed to protect their money against inflation when we set up their plan, and they needed to protect their portfolio withdrawal needs from market declines by having at least 2 to 3 years living expenses set aside for when the times the market decline, so that they don't have to be forced to sell stocks that are temporarily down to support their lifestyle. So those decisions have been made a long time ago when we set up the plan. And whether you're going through a pandemic, a recession, a political party that we're not in favor of, or any other kind of crisis or volatility, those decisions don't change. We still need to have the investments in the portfolio to protect us against the biggest threats. So let me address what the biggest threats are. We've visited this in some previous podcasts, but it's certainly important to go over again. When we talk about wealth management and wealth preservation, what is it, to what end are we managing our wealth, and what are we protecting it from over the long term? And the answer is we're managing our wealth so that someday most of us who want to retire can retire comfortably and stay comfortably retired from a financial perspective. And we're protecting our wealth from the disease, as I call it, of money, which is inflation. And so now I'm going to tie in what I referred to in the beginning as the three most important numbers in wealth management and investing. And those numbers are 10, 6, and 3. 10 refers to the last roughly 100-year annual average return for stocks, as evidenced by the Standard & Poor's 500 index. So they've made 10% a year for the last roughly 100 years, a little bit more actually. 6 is the equivalent 100-year return for a portfolio of bonds of similar types of companies. I say similar types to the S&P because we didn't have exactly the same companies for the whole period, but it's oranges to oranges, same types of companies. Bonds or lending money to those companies returned about 6% a year versus the 10% a year for stocks. And so that explains the 10 number and the 6 number. The 3 number is inflation. That's been the rough inflation rate on average for the last 100 years. So a return that we will get in investing is meaningless to us unless we know what the inflation rate has been. So for example, if stocks have made 10% a year for the last 100 years, inflation has been 3. The real return, or after inflation, spendable return, is 7% a year. And if bonds have made 6% a year for the same 100 years, and inflation is 3, the real return for bonds is 3% a year. So stocks made 7 after inflation, bonds made 3. Fully 2.5 times or so more than bonds is what stocks made. And so why is that important? If we're going to survive a period like from the time I was born, where it costs literally 10 times more today to buy what a basket of goods cost back then. So if it cost me $100,000 to buy something, beginning of the decade, I was born in 1960, $100,000 today would cost me $1 million. The S&P 500 at the beginning of the decade I was born was 60, and today at 5,000, it's about 85 times higher. So 100,000 is worth $8.5 million, and much more than the $1 million I need to buy what inflation adjusted goods and services would cost me today. So investing in real assets that make or have made 7% a year after inflation is critical to protecting our money from its biggest external threat, which is inflation. I call the disease of money. We need simply to have a lot more 7s in the portfolio over the next multi-decade period of our lives than 3s. It's just that simple. The 3s wouldn't have helped us keep up with inflation at all. In fact, bonds freeze every dollar that we invest. So if we invested $100,000 in 1960 in bonds, today the bonds are still worth $100,000 because the bond principal doesn't grow, and we've long since run out of money. So how is this related to the current environment? Well, in the current environment, when people are asking, what should we do differently in order to protect our portfolio, or more specifically, what portfolio decisions should we be making to protect our portfolio in the current environment? Whether we're experiencing an economic downturn for whatever reason, because of tariffs or anything else, or because of the pandemic in 2020. By the way, there's a parallel there. A lot of people today, they like to latch on investors to this term, unprecedented. This is different this time, Jonathan, because it's unprecedented. These tariffs were forced on us. It's self-induced. We've never experienced anything like it. And again, our memories are short. The global shutdown of the entire economy globally in 2020 was self-induced. The governments decided to shut down everything for a prolonged period of time, leading to the worst worst recession since the Great Depression, and leading to one of the worst economic growth rates since 1946. So the self-inducement doesn't have any relevance to the fact that as an investor, we still, for the next multi-decade period, need the sevens to be compounding at that rate after inflation versus the threes. The environment doesn't change that need, and that's critical for everyone who's listening to that to understand and embrace. The things that we're attracted to now to emotionally stop short-term pain is pressing perhaps the sell button. Let me sell some stocks and wait till, quote unquote, the dust settles and I'll get back in. It's impossible to time the markets. By the time the dust settles, the prices of stocks will reflect it, and you'll likely be, as many always do, buying it at much higher prices, having been much better off never having pressed the sell button, even though it's an instant relief. Because what we learn about investing in stocks, the ride up over long periods of time, it's like riding the stairs, right? Taking the stairs, and the down, like we just experienced, is like taking the elevator. It never feels good. And we imagine, gee, I don't want to go up those stairs again. How long is it going to take? And it particularly affects people who are getting a little older. So, for example, when we advise investors as part of their plan how to protect their wealth, there are two things to protect it against. One is the disease of money, inflation, and the other is themselves, the investor, and all the emotions that we are programmed with that cause us to make irrational money decisions under uncertainty. So whether or not we're 70 years old or 35 years old, we have to embrace the idea that the average time it takes from the stock market to hit a peak level. So this February, the S&P hit something like 6,200. And then to go back to a trough level, let's say the average bear market is down 33%. So somewhere in the 4,000 range might be a trough. And then to go recover all the way to new highs past 6,200, that round trip has taken about 40 months historically. So as long as we have 2 to 3 years living expenses set aside out of stocks, short-term bonds, money markets, really doesn't matter, something that won't fluctuate, so that when we go into a bear market down 20% or more, and we're in retirement, we can shift our spending to that short-term pile of money that hasn't moved or fluctuated. It prevents us from having to sell our stocks while they're temporarily down in order to support our standard of living. What it also allows us to do, having that 2 to 3 years living expenses set aside, is to have the bulk of our money compounding in stocks at the 7% after inflation rate that we've experienced for the last 100 years. And that's critical. So if someone has $1 million and they're spending $40,000 a year, the advice is, if you were prepared and you're retired, you would have roughly 80 to 120,000 already set aside. So this decline would not impede your ability to spend during retirement at all. And it also wouldn't hinder your compounding of stocks, because you wouldn't have to sell them now at all. You would switch your spending to that cash piece. So being prepared financially is important. Being prepared emotionally is also important. To put everything in context, we have a 15% average annual decline in the Standard & Poor's 500 every year since 1980. So what we've experienced this year might be a little just slightly more than average occurrence. But because of all the news media sensationalism around it, because so many people are injustifiably, in some cases, very much opposed to the current regime and what they're doing, it enhances how we feel about how bad the economic outcome is likely to be. And it may, in fact, get worse. And we've certainly had times where it's been much worse. But the focus always needs to stay on, it's okay to be afraid and concerned about what's happening to our money in the short term, to the economy and so forth. But it's also critical not to reflect those concerns by changing our portfolio strategy and going to things like cash too much, gold, bonds, because most likely we will never get back into the market in time. And those are just short-term fixes that often interfere with and sometimes destroy our long-term plan. I'll finish off by saying, no matter how old someone is in their mind relative to their planning needs. So if somebody's in their 70s, this happened 2 years ago, which is why it's on my mind. They said to me, Jonathan, I understand your advice, maybe to have 2 to 3 years living expenses so that when we go into these crises, I'm okay. But I don't have as many years as your younger clients do. So it's not the same for me. So I take a step back because I am empathetic to how they feel about their age and their time to recover. But what I say to them is, let me ask you a question. If it has taken historically 40 months to go from a peak in the stock market to a trough and back to a new high, is that average time that it's taken historically different for someone who's investing when they're 35 or 70? And of course, the answer is no. It takes 3 years on average to get back. Doesn't matter how old you are. So you don't need to have a 20-year life expectancy to deploy this prudent strategy of having 2 to 3 years living expenses and having the bulk of the money in the sevens instead of the threes. And it's more important than ever because someone today, a couple in their 70s who doesn't smoke is likely to live well into their 90s. So they have a pretty long time horizon, and the inflation compound disease of money is very real for them as it is for everyone else who's in their 30s and 40s and so forth. So hopefully this podcast will be helpful to those who are going through a pretty stressful environment right now with their money and the fears they're feeling. But to please keep in mind, it's critical to maintain the portfolio. If someone has to worry about their retirement now who is retired, financially, it just means they didn't plan properly, most likely, and they don't have 2 to 3 years living expenses set aside. And that's something that is hard to address after the fact. But in recovery, that's what those people should do. They should adopt the plan and be prepared next time. So with that, thanks everybody for listening. You can tune in always to crazywealthypodcast.com on our website, Apple, and all your favorite venues to listen to podcasts.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.